So we'll discuss the balanced scorecard components one at a time. The first one is the financial perspective. So this is the impact of our decisions on financial measures. We want to look at the balance sheet, the income statement, statement of cash flows, and any financial ratio analysis that are going to help us determine whether or not we've met those strategic goals and those measurements. The second component is the customer perspective. So this is how well we are meeting our customer needs. We might have, are we retaining our customers? What's our customer satisfaction? Do we have a loyalty program? At what rate are our customers joining our loyalty program? And if they're using our loyalty program, can we track their return visits and how often they're coming in? We might also do customer satisfaction surveys and ask customers what they like about us or to report when we're doing a good job. Those are different ways that we can measure whether or not we're meeting our customer perspective goals. Our business prospect perspectives looks at our internal processes and our relationships with our suppliers and distributors. So this looks at maybe if we're in production, what our quality measures are, how much scrap do we do, how much time do we spend with broken machines, and we have employee downtime, how many products do we have come back with warranty claims, and anything like that. We might also have relationships with suppliers and distributors that we can measure. How long does it take to get things? Do our suppliers often send us defective parts? And if so, maybe we want to look for a better supplier. We might also have how much profitability each of our distributors has. So if we have different distributors that are selling our products on an assignment basis where they pay us for the use of our products, or we have a franchise where we get paid for the use of our business name, something, how much money are they making and how are they benefiting us? The last perspective of a balanced scorecard is learning and growth. And this focuses on our organizational learning and growth. Are our employees happy? What does our employee retention look like? What are our employee training programs? Are we promoting from within? Do we have leadership training programs? We might also look at what our information systems look like. What kind of procedures do we have in place for employees and for our systems? Some things that are difficult about the balanced scorecard is that it's not always to decide which part of the balanced scorecard is more important. So we put weights on the scorecard. Another thing that's difficult is how do we measure non-financial things? How do you measure employee satisfaction? How do you measure customer satisfaction? What if the only people who fill out customer surveys are customers that are very unhappy with you? And it's also very expensive to maintain and operate a system designed for a balanced scorecard. Somebody has to create the balanced scorecard, somebody has to collect all of the information that's required to measure our components of the balanced scorecard and report out on whether or not we're meeting those goals and measurements. Last in this chapter, we're going to talk about management compensation and how we develop management compensation plans. So there are three main components of our management compensation. The first one is the most common, and that's our fixed salary. This is our annual salary or our hourly pay rate. Then other types of incentives may be a bonus that we receive in cash or stock options or any other kinds of bonuses that we might get. We might also have benefits, such as that we have paid life insurance policies, or we have paid vacation or paid health care. We might get an automobile as part of our business incentives. So we might have a company car that we get to use or have access to company assets. company apartments and stuff like this. This is a lot more common in very large corporations that might have apartments and aircraft available for their managers to use as a way to woo customers or clients. So when we decide how we're going to compensate our managers, we need to consider several things. First of those is the choice of time horizon. That means how long is it between performance evaluations? Okay, so do we look at them as they grow from one year to another? Do we have a quarterly bonus system, or a semi-annual bonus system, or is it only an annual bonus system? Then the next thing that we're going to look at is whether it's a fixed versus a variable bonus. So one might say it's just going to be, if you meet your ROI, you're going to get 1% of sales bonus. Or if you meet your goals, it's just a $5,000 bonus. So a variable bonus would be one that's based on a percentage, because that's going to slide, that's going to be a different amount or a variable amount depending on the result. Where a fixed bonus is just going to say your bonus is $5,000 if you meet your goals, or your bonus is this stock option, or this if you meet your goals. Then we have a choice of a stock versus accounting-based performance evaluation. What this looks like is how well did we increase our stock market price, rather than how do our accounting records look. So rather than looking at the financial statement and doing financial statement ratio analysis, we're going to look to the stock market performance of our stock. For publicly traded corporations, a really good manager can sometimes have really great effects on how the stock is trading in the marketplace. So we as a company might want our manager to focus more on making decisions that increase the value of our stock than in making our accounting records change considerably. Okay. Then the next one is whether we're going to reward local performance or company-wide performance. So do we want our divisions to compete with each other? So we're going to just reward the best division? Or do we want to maximize our total company-wide performance? How do we want to motivate those employees? Maybe a combination of the two. We want our divisions to compete with each other a little bit, but not to the detriment of entire company-wide performance. We also want to look at that we want a combination of these things, because a combination of performance measures and management compensation choices reduces the likelihood that our managers will commit fraud or unhealthy accounting practices in an effort to make a single performance measure better. And we also have a cooperative versus competitive incentive plans. So this also looks at if we're going to reward individual performance or if we're going to reward everyone in the group. This is another way of looking at the company as a whole, regardless of just one single division or one single employee. It's more likely that we're going to work together if we have a cooperative plan where everyone benefits, versus a competitive incentive plan where only one person can get the bonus based on particular performance. So we talked a little bit about ethics, fraud, and corporate governance throughout these videos, but this slide particularly talks about management compensation that gives them access to company planes or luxury sports boxes or season ticket seats, floor seats to somewhere. Sometimes these things can be controversial and subject to abuse. So we really need to look at what point is it a management perk, and at what point does it become abuse? So do we allow managers to use that as a perk for personal reasons, or is it specifically that they can only do it if they're taking customers out or if they have other employees out, and as soon as they use it for personal reasons, then it's an ethical abuse? So we want to make rules that are authorized by the board of directors, properly disclosed in our financial statements, and we might also include these in the taxable compensation of our employees. And that's not uncommon. For example, if you are provided clothing as part of your job, you can be taxed on the value of that clothing your company has provided. So if you are given a uniform and that uniform is yours to keep, or it's custom size or has your name on it or something, you have to pay income tax on that uniform. It's part of your taxable compensation for payment. If at the end of your employment you would return that uniform, then it's not part of your taxable compensation. But there are perks that will become part of your taxable compensation, and this is a way to reduce some of that ethical abuse of products. So that is the end of chapter 25. And the next chapter we're going to look at is chapter 26, capital budgeting.